Hi there, everyone, and welcome to this month's edition of On Track. It's the 29th of January. As I record this, just finished the Australia Day long weekend, and hope you all had an amazing Christmas, New Year holiday season. And yeah, certainly it's hot here. Was lucky enough to spend some time in Canada and the US, where it was rather cool, but back to the heat of Australia in more ways than one. So just our usual warning. This recording is for clients of McGregor Wealth Management, particularly those that use our care investment philosophy and portfolios. For everyone else, you're welcome to listen in, but please seek out advice before you act on anything we talk about. I'm going to cover all the usual stuff today. We'll spend a bit of time wrapping up 2023, having a look at how it turned out. We'll talk about what's in store for 24. We'll revisit the Magnificent Seven. I'll talk about property and shares, where they're sitting. And I'm going to have a few themes today around diversification and new highs as we approach new highs in the market. So news as we kick off the year, the market's finished extremely strong in December, from lows in October that were looking like we're going to have a pretty ordinary year to a 10% straight up gain to the end of December. And then we eased in January. But we're actually hitting new highs as we speak, as the markets want to move forward. In Australia, locally, we've had the Albanese government announce changes to the stage 3 tax cuts. And depending on which angle you look at it, you can say it's really good or really bad. Bad because they broke a promise, good because it delivers more tax cuts to more people. Bad if you're a high income earner, great if you're a medium income earner. As usual, our self-focus and perspective. Economically, it's not crazy. It actually makes a bit more sense in some ways, but it continues to ignore the long-term lack of major tax planning on both sides of politics. We need a revision in the tax system, but no one seems to want to do it, so they keep messing with the edges. That was this one. Cash rates neutral, and as we scroll down all the rates, we can see the RBA cash rates now been steady for a while. Most of the market is pretty confident that we're not going to see any hikes. Next week, we'll have the first announcement for the year, but it's unlikely to be an increase. It's also unlikely that it's likely to be a decrease, and the arguments around when a decrease might occur range from anywhere from March, April, right out to December. And the reality is no one has enough data, including the RBA, to know exactly when that will occur, but it's probably fair to say we've peaked unless something else happens. You can see global inflation here. When I say global inflation, the big economies of the world, the UK, US, Eurozone, Japan, China, and you can see that spike in inflation we had from the bottom of COVID, when government spent a fortune keeping everything afloat. And we all got worried about inflation, that it was going to get stuck in a 1970s, 80s type environment. And it certainly hasn't. It's fallen. It's come back into a reasonably good zone for most. You'll see China's actually deflationary at the moment. And part of Australia's situation in the world is we import whatever's happening elsewhere in the world. So if we've got disinflation, we'll tend to import that a little bit. If we've got deflation in places like China, we'll tend to import that a little bit. And the only thing that makes us different is our wage system. And the only thing that risks us staying a little bit higher than the rest of the world will be if wages go up by more and it gets pushed back into prices. The stage 3 tax cuts, which will kick in on the 1st of July, will definitely be inflationary. When people have more money in their pocket and they spend it, that's inflationary. It may be a good thing. We've got 5 months between now and then. If inflation's fallen in that time, it's probably not going to be an issue. If inflation's stubborn for the next 5 months, then it may add to that stubborn inflation, which will mean interest rates stay higher for longer and higher at the rate. So you'll see, and I'll go from the bottom here. Term deposits, 4.8%. They're dropping a little, even though cash rate hasn't changed. Banks are increasing their margin. Variable rate mortgage from Macquarie, one of the best rates around, 6.24. We're seeing some discount rates as low as 5.94. Not many. Most banks have got their rates set at about 6.75. US inflation, 3.4%. It's heading towards that magical sub 3%. Australia's last number. The number comes out in the next few days. It always comes out just after we do this. So We expect it to be slightly lower, but no one ever knows, and 1 month's number doesn't make a difference. Aussie dollar, a little bit weaker over the last month. 10-year bond yield went up marginally, but it's coming back down again, and certainly steady. We'll touch on that in a little while. Portfolio return. So to the end of December, let me walk down the 1-year numbers. So Chant West, who are the superannuation researchers, had an article out that you may have heard or seen that said the average growth super fund was about 9.9% for the year, which sounds pretty good. Put in perspective, our core growth fund was about 12.82. Our growth portfolio with care, most of you would have, excluding reserves, about 14%. So we're very happy with the numbers for the year. Very tricky to compare at the moment. Lots of industry super funds don't have their full numbers out for December. So just make sure you're comparing apples to apples. That is December 31, etc. But a good finish to the year. Those 5-year numbers are looking right in line with our long-term targets, which is great. With the little increase we've had in the market at the investment committee meeting we had last week, we bumped the dial up slightly, not with any concerns, just to say the market's running well. If things go well, it'll probably be fair value. But if inflation lingers a bit longer, we're just saying just over fair. Just over fair doesn't mean we trade on that or do anything. It just says, we're a little bit above where fair value is. And we say that knowing that we have no exact idea on this, and neither does anyone else. It's our best assessment of where the market is. It helps us make decisions for you about entry and exit of portfolios in particular, about good times to rebalance. And that's its purpose for us, not to trade, not to do anything else. But pretty comfortable with where the markets are at the moment. And having said that, they have run a little bit ahead. So we're hitting new highs. So you're going to hear people talk about new highs. It's terrible. It's going to crash, as if for some reason, whenever we hit a new high, the market drops. And I'll talk about that in a minute. But once again, this shows the steady grind. We had a boom, our FOMO period back in GFC, a bust, and then the market's ground its way up the hill through the wall of worry. And we're still not in any major boom at the moment. It's just been a constant climb over that last 15 years, where we've had 5 downturns, 6 downturns of more than 10%, more than 12%. All based on different fears. And as those fears ease, the market gets on with its upward trajectory, which is always caused by innovation, evolution of us as a species as we get better, faster at all things. So let's ask ourselves that question. Should we be scared of new highs? Here's a 100-year chart of the Dow Jones 100. It's the Dow Jones Industrial, which is one of the longest indexes that's been around in the world. You'll see early on there, a massive boom in the 20s, massive bust, and then a recovery. But the market actually spends, about 70% of its time in new highs. So once we make a new high, and if you look at this period, it's about the 60s through to 80s. The market was stagnant for a long period of time, and then it broke through a new high. And at that stage, you'll see the grey bars here are recessions as well. So you'll see during that time, there was 4 recessions in the States. And for most people, their history in investing goes back less than 10 years. So anyone who was an investor in that period was scared of highs, because every time it got to a high, it would come back down again. And there was a recession. And eventually it broke through and it took off for one of the most prosperous times. That is from the early 80s, from the early 80s through to 2000s, one of the most extremely prosperous times. So we should never be scared of new highs. People are scared of highs as if they're standing on the top of the mountain looking down, but that's looking backwards. If you stand at the start of this mountain and look up, you go, wow, we've got a long way to go. And that always remains the same. Let's revisit those tailwinds and headwinds, and I made some slight adjustments there. But inflation looks to be moving lower. No one can tell for sure. Obviously, if it doesn't fall as fast as we would like, that'll be a headwind and slow down share market growth. Lower interest rates will definitely help the share and property markets. And but we're still in that final stage of lingering doubt where there's still a bit of a slowdown going on. Rate cuts, eventually when they happen, whether that's in the next 3 months or 9 months, somewhere in that vicinity or later, that will stimulate the world. When interest rates drop, people, businesses have more money to spend, and that stimulates the economy. Headwinds there, continuing geopolitical events, although most of them are built into the market. We're not, even though they're horrible to look at, they don't really affect our economy. We're not even worried about the skirmishes around the oil routes at the moment. It's not really impacting stuff too much. Company profits are actually doing okay. As we look through the company profits, both here and in Australia, they're doing okay. Corporates cut costs where they needed to stay profitable, and they're doing okay. And the hidden one for the next decade is that we're going to see technology gains continue like they have through our entire life, through AI, robotics, automation, and that's going to increase the profits of everyday companies, not just the big ones. At the moment, we're seeing the profits and the outlook and the share price for the Magnificent Seven, so the leading companies in that space, go through the roof, and I'll talk about that in a minute. But eventually these things hit all companies and affects their profits. We will have the craziness of US politics this year. There's still a slight chance Nikki Haley is staying in the race at this stage, but it looks like she doesn't have a huge chance. So we could see as early as in the next few weeks, it's just Trump versus Biden, no challenges. Now, normally one of the parties is still sorting out who's going to be their nominee for the next 3 to 4 months. So this means we're going to have 9 months. The US election is on Melbourne Cup Day. Always funny how they copied that, but no, tongue in cheek. It's the first Tuesday in November. Just happens to be the same day as Melbourne Cup Day. So we're going to have 9 months of just watching these two old men try not to have memory slips, and they're both going to be just as bad as each other. It's pretty pitiful. Thankfully, only 4 more years, and let's hope the next generation of US politics starts to stand up. That's all I'm going to say on that. Yield curves, interest rates, and I printed this and put it in late last week so that you can see 10-year bonds steadying at that 4.2%. When we look at the bottom of the table, Australia on the left, US on the right, we can see after that dip to once in a century lows that we had post-COVID, we've come back into a reasonably normal space. And as we've steadied, that's good news for underlying markets, and we'll see which way it goes from there. And just a revisit the Magnificent Seven, I spoke on this. So the Magnificent Seven is 7 stocks: Alphabet, which is Google; Amazon; Apple; Meta, which is Facebook; Microsoft; Nvidia; and Tesla. We all know Tesla. Nvidia is a company that makes chips, particularly for computers that specialize in AI. So this is an AI-driven boom. And as you can see from this weird article in the Daily Mail, not one of my favorite newspapers, and you see this Daily Mail, UK newspaper, Australian, but then the headline they're talking about 401ks, which is, so it shows you how they rehash news around the world. But what I did like here when I was searching was just this information. So last year, those Magnificent Seven stocks went up 75%. So the other 493 companies in the S&P 500 only up 12%, which was quite similar to Australia. What does that mean for your supers? Obviously, and I'll go back. Let me go back to the care returns. And we see that come through in international shares, 25% for last year. Australian shares slightly lower, 9% in our portfolios there. But the beautiful power of diversification, put it together, and we had our high growth at about nearly 15%, growth at 14%. So these were coming through, but the mainstream stocks, Australian shares, broader US shares and others, didn't do as well. They did fine, 10 to 12%. That range is fine, but not as much as that Magnificent Seven. The beauty of diversification is if that reverses this year, we've got all of those bits. We're not punting on one theme or another. We will see the benefit of those as we have done. But we'll also see the benefit as the more mainstream share market companies pick up on the profitability of that. We're going to see this theme go for a while. Just to reiterate our cycle where we try and assess where we are. So the share market cycle is boom, bust, wall of worry. We've been in the wall of worry for a long time, this cycle, since 2008, so 15 years. It makes sense that somewhere in the next 3 to 7 years, we'll probably have a boom, just on the law of averages. It says we're going to have a boom every 20 years or so. It never feels like it when it's starting, and it certainly doesn't feel like it now, but just on the law of averages, it's inevitable, just like we saw the property boom we had at post-COVID, which didn't feel like it should have happened as well. So dial at 8, new highs, as I said. I won't go into this, but just to say that we're not in any conditions that make major downturns likely. In terms of our method up, and most of the themes today, I'm going to talk about diversification. One of the challenges for investors when they start to hear things like the Magnificent Seven is they might decide to focus on that alone, and that can lead to danger down the track when it eventually comes down and down big time. So one of our beliefs, as you all know, broad diversification, which means we get consistent returns and we never fall victim to any one decision. Our definition of diversification is just where you bargain away the right to make a killing in return for never being killed. A fair trade that we think. And I'll get into that. My behavioral bias for this month is something called the endowment effect. And it's an emotional bias that causes individuals to value something they own irrationally higher than what it's worth. So, and I'll give you an example. Someone may have, and I'll use it with life insurance. We, for our younger clients, make sure they have enough life insurance as they build their wealth. We talk them into reducing their life insurance. And ironically, we see two things. When people don't have any life insurance, they resist getting it. But once they've got it, they resist getting rid of it, which is really interesting. So I'll have a client, and if I was trying to advise them to buy that insurance now, they probably wouldn't do it, but trying to get them to drop it down as the wealth has increased. We see the same thing in share markets. When they own a company, they're less likely to want to get rid of it. They value it higher without any rational basis. So just one of the many behavioral biases that cause investors to underperform their investments on average. Our investors don't do that because we're very aware of it and we've got processes to navigate around that. Once again, our care process, which is a broader process, which helps with all that, and the 4 pillars that underline that. Modern portfolio theory, managing that investor behavior. I talk so much about learning from history, but most of all, making sure your plans are based on your circumstance. But once again, the message today, diversification. Let's have a look at individual sectors. Australian shares up 12% for the year. As I said, it was looking pretty horrible back here at the end of October. At that stage, it was looking like we might end up down 10% for the year. So a phenomenal comeback. Once again, diversification. Have a look at the companies you own just in the top 10 of your Australian shares, BHP, Commonwealth Bank, and look at the differences in returns. The best performing leader in Australia last year was Wesfarmers. The worst result was Woodside, down 8%. So this is where diversification averages all those things out to a nice steady 12% return. And you put that over 10 years' time, and value of $10,000 grown to just under $27,000. US shares, so in the portfolios as VTS, phenomenal year, 25%. But as we saw before, driven by the Magnificent Seven. And there you can see them in your portfolios: Apple, Microsoft, Amazon, NVIDIA, Alphabet, Meta, Tesla. Right behind them, we've got good old school Berkshire Hathaway, which is Warren Buffett's company, and Eli Lilly & Co., a drug manufacturer that's entered the top 10 for the first time that I can remember. And we see the growth there at $10,000 through to $60,000. And we're definitely seeing new highs in the US market. But as I said before, not something to be scared of. At the end of a cycle, and when I say at the end of a cycle, we're at the end of an interest rate cycle. So we've seen interest rates go up and we've seen them pause. Once they start to go down, that turning point is the end of a business cycle. And that is normally a good time for shares when interest rates start to drop. Global leaders, which is the top 100 companies in the world, which we hold in the active portfolio. Once again, the leaders, Magnificent Seven, has led this to be up 26%. A great year. Once again, diversification. There's literally 3,000. Sorry, this global leaders is 100 portfolio. The US market stock I talked about before, there's thousands of companies in that portfolio. And then we get to US small caps, which had a 15% year. It tracks similar to Australian shares at the moment. It doesn't always. Massive diversification. You can see the top holdings in this one, only 0.7%, whereas in the global leaders portfolio, Microsoft's 12% of that. When you go to the Aussie portfolio, BHP's 11% of that. So drop down to small caps, and there's about 4,000 companies that make up IGR. Small holdings that give you the benefit of all different types of of technology and other bits and pieces coming through. And $10,000 in that has been a stellar performer, averaging 11.45% over the last 10 years, which has given growth, of 10,000 to about 50,000. Emerging markets is the underperformer of the last 5 years, and of the last decade. So, and of this year as well. 1 year return of 5.35. I should point out, it's still better than cash. And even the 10-year return at 4.5% is better than cash. And when this turns, and you'll see, this has unashamedly been held back by China and the sovereign risk around China. But you'll see some fantastic companies here. Taiwan Semiconductor chip maker out of Taiwan, Samsung, obviously the phones, etc., out of South Korea, Tencent, Chinese tech company, Alibaba, Chinese tech company. Now, these press earnings ratios for the Chinese tech companies are about 7 to 13, whereas the equivalent US companies are trading at a PE of 35. So even if these PEs came back to half of that, you would see a 50% increase in emerging markets. So we remain committed to emerging markets over the long part of the cycle. We continue to review and rebalance, and at some point it will turn into the superstar that it becomes over the long run. And still 10,000 investment 10 years ago would have gone close to doubling in the last 10 years. Gold, our insurance policy that sits in the portfolio, it had an okay year, but it came back in the last 6 months of that year. It had a really big run up, and then it's held. So still an important part of the portfolio, and it's managed to deliver better than cash rates over that period as well. Let's talk property and property cycles, and this model here is slightly different to our boom bust wall of warrior. We've got boom bust and boring here, and that the property market can have long periods of boring where it doesn't do much. Then it can go crazy within a few years, which we've seen in the last few years. Then it can retreat, sometimes a little, sometimes a lot, and then through the boring. Now, there is no one market. So the Australian property market is broken into a lot. Firstly, we'll look at the states here, and this is where 2023 finished. So as we look at the total return, so the annual return plus rent here. So the annual return here shows just the growth in property. So combined capital is 9.3%, but when you add rental into that, you start to get a total return. A spectacular year for property again, and given the interest rates, it's quite amazing. I'll talk about why in a minute. You can see here the median values of all the cities as well. So Sydney now, median is that property that's half properties are valued above it, half below. It's not an average, but it's like an average. So 1.1 million means you can find 50% of properties under that value, by the way. Melbourne 780. Look at Brisbane. It's almost caught Melbourne there. Well, sorry, it has caught Melbourne there. Adelaide the same. That's probably telling us that Melbourne's undervalued, although Melbourne is an extremely diversified market. It is a very wealthy suburbs, but then big tracts of suburbia, which are more like the burbs of Brisbane, Adelaide, etc. Perth's had a great comeback. We've thought it's been undervalued for a while, but it's starting to develop a total return of 20% for the investors in Perth in the last year. And the laggard here is Hobart, but Hobart had such a magnificent run. It's not that many years ago that the median value in Hobart was sub 300,000. So Hobart's joined the other capital cities, and Darwin's always in this list, but I'm always reminded Darwin is about the same size as the Sunshine Coast, so I don't regard it as a capital city property market in the same way as the others. So what's driving some of these things? Look, Queensland tops this from this this chart I found. Queensland net migrations. So this is net migration, interstate migration. So it shows the movements of people. Now, keep in mind, this doesn't allow for the immigration nationally. So you got this, we've had a massive immigration. So in terms of the spike, the dark blue line in the number of people coming into Australia in the last year and a bit. What happens? People tend to come in, so just go back, arrive in Australia, Sydney and Melbourne, and then slowly people move to Queensland and Perth. That's been our longer term trend. That's why Queensland and Perth are good growth states, and that's why the future of Southeast Queensland property is solid as is WA. So we can see that 31,000 people in the quarter. This is March 23, by the way, so this data lags. But yeah, that continued flight to Queensland plus immigration. Let's have a look forward. No crystal ball. I don't have one, never had one, but we tend to do an assessment of these tailwinds and headwinds just to see where we are. But on the tailwind side, we've got continued population growth. That means more people need houses. And if anyone's built or done any renovations lately, they know how much building costs have gone up. Building costs have almost doubled in the last 5 years. So that means someone building a house that used to cost $500,000 is going to spend $1 million. That's not unusual. So all of a sudden, add that to land value, and that's part of why property prices are going up and will continue to go up until that sort of stabilizes, if it stabilizes. There's currently a shortage of about 100,000 dwellings, and that will take some time to fill. Rents are still rising strongly because we've got some of the lowest occupancy rates that we've ever seen around most of Australia. And as we gaze forward, as interest rates start to fall, that should see consumer confidence kick in. When people are confident, they're more comfortable making property decisions. On the headwind side, affordability, when you've had a run like we've had, it pushes prices up. And especially, I think if interest rates are stable at the higher levels that they're at now for the next 3 to 6 months, that's going to take the sting out of the sale of the property market early, particularly in those areas where affordability is an issue. That's where young people are buying. This is not so much of an issue in well-established areas. I think about Toorak in Melbourne, Coogee in Sydney, places like that, where there's a turnover of houses with people who don't really have mortgages. That's not so much of an issue. Another headwind, we're still not through this. There's still lingering chance of a slowdown, recession. We have seen unemployment go up, which is one of the headwinds as well. And unemployment had to go up. That was how the Reserve Bank and the government knows that they've slowed the economy down. So it was inevitable. So the fact that we've seen that helps look towards the end of that cycle. Higher interest rates are still impacting. And the last point I've got here is we built up an incredible amount of savings through COVID. Those savings are slowly being depleted. As they're depleted, that puts people in a tough position. And if they get into a tough position, they may become sellers, and that will provide a negative to the property market. The broad consensus for the property market by the economists, who have a terrible track record, by the way, is an increase of about 5%, although some of the leading economists I admire are predicting -5%. I just think it's going to be a fairly steady year, but dive under the bonnet. That's Australia-wide. Dive under the bonnet, and every suburb has its own story. So when you're looking to make property decisions, you need to be mindful of what's going on exactly where you are and how it fits into your plan. Interest rates, pretty benign. No major movements. We're still stuck in this mid 6%, both for variable and fixed rates, and we're going to stay there until the market starts to see that we're likely to drop. Property clock, we're still seeing here. So houses on the left, units on the right. So we're still seeing this perception. And our friends at Performance Property who provide us with this have some of the best data around. Keep in mind, their goal and our goal is to help clients make good long-term decisions about property. The short-term is always unknowable and stuff moves, but you still can have an assessment of where things sit. So on the housing side, for the blue chips, we still see Perth. The WA is probably providing the best value. And you can make a case for some suburbs in other places as well. Units lagged over the last 3 years, or back to COVID. So there's a case for units in some areas. You got to be more careful with units. They have a higher cost, etc. But there's certainly a case for units, and I'm just looking at where they are. Yeah, Melbourne and Sydney are probably on the catch-up market in units for the. Yeah, and you won't see here no AAA units start at the BBB. This is Performance Properties way they characterise it, which I'm very comfortable with. Our preference is always properties in the major growth capital cities or areas within a 2-hour drive. And this is a short-term picture for people buying for the next 20 years. All of these areas will do well. So sometimes people want to buy in Sydney, for instance, because they know it's going to do well in the long run and they've got money, they're in a position to buy. So they're happy to buy it, even though it's in that stagnation process. If you're looking for a hand with property, please yell out to the team and we can help you with stuff there. So just in wrapping up, as usual, and thank you again for those that make it this far. I know it's pretty much the same thing every time. But yeah, we do have these really strong beliefs, which leads to our process, and that's all investing best done as part of a real plan. It's where we know you, we know your goals, and we know what's important to you. Portfolio is designed to meet those goals, and we take a long-term view. All the boring bits that do give us a wonderful result in the long run: diversification, asset allocation, liquidity, low cost index for most of those markets, which gets us in. So that's helped make our returns well above average over the last period of time with below average costs. We protect against the short-term volatility with reserves. So having a buffer for our retired clients and dollar cost averaging, just by firing at the market every month for our younger clients. We rebalance regularly, so as one sector goes up and another goes down, we'll sell a little bit of the thing that made a profit, buy a little bit of the thing that didn't make a profit, and they invariably switch, and that adds value over time. Roughly 0.5 to 1% of long-term performance comes from that disciplined rebalancing. And as I always finish it, there is only 3 ways to lose money in the broader share market, particularly. One is if you panic and sell, the other is if you have to sell because you need the money, and the other is because you're not properly diversified. As I've talked through today, you have massive diversification in the portfolios we look at, and that's led to good results in what was a crazy year. Thank you for listening. Thank you for your support as usual. Let's hope 2024 is a good year, not so much in the markets, but for just in people and their lives. And until next month, Rob McGregor signing out.